Welcome to TheoTrade. This is Don Kaufman. September 2nd, 2022. Doing the weekend update here with 17 minutes to go to the cash close. SPOOs. Listen, nobody saw this one coming. Down another 1.5%. Is this relentless selling only the beginning? I think everybody's got to be asking themselves that question as we come in, of course, to this holiday weekend. It's Labor Day weekend. Of course, the futures markets, though, will still open on Sunday night. They'll reclose Monday morning. But the next full day of equity trade will not be until, of course, Tuesday. All right, let's get down to business of why I'm kind of questioning some of the relentless sell side activity. First and foremost, to zoom in to some of the trade on an intraday basis. As I said, I don't think anybody saw this one coming. We had and caught a nice bid off of the employment situation. Non-farm payrolls came out. They loved it. We faded, we threatened, we bounced. I mean, we were trading 40.19. Look what a difference a few hours can make. I mean, if you're talking about volatility, this is it. But I'm gonna mention here in just a moment, and again, a huge faction of this weekend's update has a lot to do with what we term the volatility complex. I see considerable issues on the front of volatility, which again, I'll mention here momentarily. But just to mention outright, okay, talk about a reversal in a market. Again, we're 110 handles off, okay, this high, which was, again, just a few hours ago. And if I sound surprised, I am. I'll be very frank in saying I walked away from the screen for 15, 20 minutes. I'm still glancing at my mobile device, doing a couple things around the house. Next thing I know, the SPOOs are only up 15. Then they're down 15. I said, here it comes, 39.31, and we're home. However, okay, coming into this cash close, we've now broken off the 39.31 gravity point. This is an absolutely critical level, okay? We lost it. Speaking of another absolutely critical level, do you know where we are on the week? I think this is critical as, again, we have 15 minutes to go to the cash close. We are absolutely outside the lower edge of the expected move. Lower edge of the expected move is right around 39.50. And I discussed this in really deep extent on Wednesday night's video, how there wasn't much standing between us and, it was 39.50, and then ultimately it was 39.31. We're going to talk about these levels again. Before I get there, and again, we're outside the expected move. So here's where things, listen, the bottom line with this is where things just get downright nutty. You got 15 minutes to go to the cash close. Contract size in the S&Ps, it's not massive. We're averaging maybe close to 5,000 contracts a minute. Volatility is definitely up towards the highs of the session. You'd expect that. The VIX, though, listlessly higher. I mean, look, the VIX is actually up some 2%. Bonds all of a sudden trying to reverse. We'll discuss those here momentarily. But the only sign, I think, of a really just a ripping reversal is in the dollar. I mean, the dollar, if there's something scary on today's screen, it's not the fact that the S&P is reversed. It's the dollar. Dollar was actually off big. I mean, it was trading like 109. Here we are trading almost, again, 109, 70. It's a wild reversal. Again, even more sizable. If you put in terms of magnitude, I think you have to understand that the reversal in the dollar, to me, has got more magnitude to it than the S&P futures. All right, let's get down to business. Let's come out of the intraday trade for a second. I want to start the weekend update with a discussion about the volatility complex. And what I mean by volatility complex, I'm just talking about VVIX and vol futures and VIX and SKEW. It's downright frightening. All right, it's downright frightening. I'm going to explain exactly why. I mean, I'll start with the most, I think, if you will, common way of looking at this, and probably the easiest way to be able to interpret why The vol complex is downright frightening. All right, so we've seen some relentless sell side. To quantify that, I talk about relentless sell side, but to quantify what relentless means, here we are trading 4,300 after a 6-week, rally to the upside. And all of a sudden, lo and behold, the marketplace comes off of, we'll call it 4,300. Here we are trading 3,900. All right, so lo and behold, we've just lost 400 points in the S&Ps. Let's just roughly put it at 10%. All right, it's a little more than that, but let's roughly put it at 10%. So you get this 10% dip inside of the marketplace. What does VIX do in the exact same time frame? It moved. Like, there's no question that VIX, is bid up. But I don't know. The last time that we were down here in this 3,900 handle, okay? And again, we could point out here, but this was already in the midst of a rally. But the last time we were coming down hard and fast in the middle of this, it was all the way back like June, okay, June 10th or so. And I want you to take a look where volatility was at that moment in time there. Again, that June 10th, we're trading what? Here, 28, jumped up to the 34 level. Listen, volatility at this point is looking at the marketplace. It sees the risk and it's saying mundane. It's just, again, it's, watching this movie and you've seen something scary. And then the next time you see it, it's not as scary. And then the third time you see it, you go, whatever. But that's not, that's the easiest way to interpret this, but that's not, to me, per se, the cause for concern. The cause for concern is much more what the structure of like vol futures looks like, okay? And this is going to get a little bit deep, and then we're going to talk about VVIX, and we're going to look at SKEW, because they all are just downright frightening at this point. So with the volatility futures, my cause for concern is simply that we're still in, and again, I'm going to freeze the screen for just a moment and show you. All right, let's kind of zoom in over here. The vol futures that matter right here, these 19-day vol futures, they matter. Okay, then just jump out to the 47-day vol futures. They matter. Why do they matter? Because these are the contracts that actually trade. So what we have here is the 19-day is trading for roughly 26.14. Go a little further out in time. Those 47-day are trading for roughly 27. Okay, so we're still in about a 75 cents contango. And I say this in the nicest way, but after everything we've been through together, we're in contango. We just saw the marketplace fall by 10, 11%. We're in contango. Doesn't exactly do it for me. I kind of would have expected maybe vol just to kind of flatten out. And when vol flattens out, or vol goes what we call inverted, what inverted means is, let's say that says 28 and this says 27, and that basically means the 19-day versus the 47-day, right? If the 19-day we're trading 28 vol, and 47-day we're trading 27 vol, that basically implies like, that's it, baby, it's on. That's a catastrophic move, because you're implying that there's actually more risk now than there is 47 days out, which almost like, it's incomprehensible, because you're thinking, how can there be more risk with a shorter amount of time? It just basically means the world is blowing up harder now and we'll revert back to something more mellow in the future. You do realize what this means. What this means in contango is, yes, right now we're trading at 26, but just wait, because 47 days from now, we're at 40, we're at 27. And you're looking at this, what? The October volatility is still considerably higher than the September volatility, which implies, okay, we're not home yet. We're not even close to home. And by home, I just mean is, it implies there still could be a lot more risk to come. And that's, to me, is a little bit frightening. Now, vol futures unto themselves don't mean a whole hell of a lot. But okay, I'm going to put this all together in a second. Let's go down and look at VVIX. VVIX, the volatility index, which is often indicative of people hedging. Of course, I asked this of a group the other day. I said, how come nobody's hedging? And somebody said, maybe nobody has any positions. They always have positions. Okay, no one's hedging over here. There's like no fear and loathing. This is one of the lowest levels. Okay, one of the lowest levels in years. Go take a look. It's a 5-year chart. Look at that. Okay. Some of the lowest levels in years. It's just like, whatever, man. Okay. We're going down. Nobody cares. Right? Look at this 9-day volatility. 9-day volatility is actually down today. Just want to point that out. 9-day volatility is actually down today. And granted, we're coming into a 3-day weekend, but that's down today. So VVIX is the volatility index, and it's indicative. When it's low, it's indicative that people just aren't out there hedging. Okay. Last but definitely not least, let's bring SKEW into this. Okay, where's SKEW? In fact, I'm going to open SKEW to the very max chart we have. Where's SKEW? Down to about 120, which is, for all intents and purpose, some of the lowest SKEW that we've seen. Now, SKEW implies out of the money puts versus out of the money calls. There's not a tremendous demand to buy out of the money puts. Okay. Now, there could be some demand to buy out of the money puts, but we know there's not a lot of demand to buy out of the money puts, because if there was demand to buy out of the money puts, the VIX would go higher. And if the VIX went higher, okay, if we saw SKEW go higher, VIX would go higher. And if VIX went higher, all of a sudden they go, oh, puts are getting expensive. Then they rush into to buy calls in VIX, and that actually, makes the VVIX go higher. None of which is actually transpiring. So why do I care? Why should you care? Because the volatility complex is frightening. And I'll tell you why the volatility complex is frightening. So all this relentless sell side activity kind of transpiring, we're getting pushed to the downside. Volatility has yet to even catch fire. And the disconcerting area of this vol complex is simply this. The way that hedging works, is that all of a sudden, let's say all of a sudden we have a precipitous drop lower. Let's say we drop immediately to like 37.50, totally plausible for early next week. We drop to 37.50. At that point, trade starts to feel the fear. Volatility rips. How do you hedge volatility? Because come on, now all these market making firms, people are buying volatility. Somebody has to sell volatility. And volatility is not just going to go like listlessly higher. Eventually, volatility is just going to go, holy crap, we got to catch up. And volatility is going to explode. And the second volatility explodes, how do the market making firms hedge off their vol risk? Okay? We're going to sell S&P futures. So we're in a position right now where you actually want to see, when the markets are going down, you want to see expansion of volatility. When the S&Ps are down over 1% and the VIX is flat, like how does that make you feel warm and fuzzy? It doesn't make me feel warm and fuzzy, because sooner or later, trade's going to reach for vol. Okay. And when trade starts to reach for vol, meaning they're going to buy it, and they're going to buy it at any price they can get it, doesn't make a difference. And guess what? The market making firms are going to sell it to them. And then the market making firms, turn around and they're going to sell, the living crap out of the S&Ps. We have got, a volatility complex problem. And, well, it's a little complex, but it's downright frightening. It's frightening because we just haven't seen this, evidence of this playing out at all right now. And I'm going to tell you right now, when it comes to volatility, this is where I live, this is what I know, and I tell you, this doesn't have to happen, meaning that I don't want you to take me saying that the volatility complex is frightening as a bearish connotation, because that's not what I am implying. What I am implying, is unequivocally, however, if we go down, we're going to go down big here, really big, frighteningly large, because the nature of the hedge is actually going to drive a stake right into the heart of the S&P 500, right? Not exactly a warm and fuzzy thing to go into, of course, on a 3-day weekend. Next, let's actually move on to the dollar. The dollar also presents a cause for concern. Now, Wednesday night, what did I say about the dollar? What did I say? If you watch the Wednesday night video, so the dollar is beautifully poised for a breakout. It broke out. So in effect, it opens the door at this point in time to more sell side activity. I mean, for the most part, the dollar is kind of being used almost like, what the bonds used to be used. Meaning that, used to be kind of duck and cover. That is, everybody get out of the S&P 500 and buy bonds. Instead, now it's like, everybody get out of the S&P 500 and buy dollar? I guess so, Hey, listen, I'm new to that as well. But the dollar, the strength in the dollar presents its own problems, because strength in the dollar implies exporting Inflation, stronger dollar kills the euro. Their buying power is not as good. Everything looks more expensive, especially when it's priced in US dollars, like every single commodity each trade. Okay. Again, we're getting downright ugly with the dollar breaking out. Okay, let's switch gears for a moment. Let's cruise over to the bonds. And in this particular case, yes, I'm looking at the ZB. The ZB is bouncing today, but I want everybody to look at this chart. As I said, my notes here, you need to see this bond chart. Go over to the TLT. Go over to the TLT. You're like, okay, so TLT has gone lower. We're talking a once in a generation type move. Go to the TLT and go over to the max chart. In the max chart, I want you to recognize, and again, I'm going to close up the left sidebar. I don't care that there's 80 seconds left to play in the marketplace. S&Ps are just hanging on to 3,900 like it was grim death, and close up that left sidebar. When I talk about a once in a generation type move, okay, I don't take it lightly. What you're looking at in the TLT, okay, is all the way back into roughly 2002. You do realize at this point in time, okay, this is effectively the largest move that we've seen downward in the bonds ever, okay, in recent times. This is one of the most vicious moves. And the reason that I am bringing this to light is the move inside of the TLT, which also, of course, correlates to the ZB, to the ZM, is catastrophic enough that it portrays a tremendous risk moving forward for the S&P 500. If we're talking about bear market territory, a once in a generation move in the bond market, okay, the implications for the S&Ps are not. There is the closing bell. Look at this. We're trying to hang right back on to 39.31. But a once in a generation type move in the bond market is not something to be taken lightly. The bond's officially now in a bear market territory. I am not one who likes to quantify and qualify, for instance, the bear market. Okay, but at this point, looking at the chart, it's just downright awe-inspiring. And the thing I think that resonates with me most about just looking at the chart, and again, it's just, superfluous to just look at the chart, but the sheer magnitude of the move, and you start looking at the S&Ps and you're like, oh boy, okay, we got, and you know what? I'll zoom into the exact same time frame. So not to confuse it all, we got ourselves some issues here. We got ourselves some dramatic issues. And again, I'm zooming into a similar time frame when you see the bond market in the midst of an outright just spasm to the downside. Interest rates are exploding. Everybody's looking at the S&Ps coming down, yet they don't have the recognition, if you will, of the damage that's already been inflicted, okay, to that bond market. Something to keep in mind in the very near future is that pressure does not seem to be abating in any way, shape, or form. All right, let's come now into the S&Ps themselves. So in the S&P 500, specifically the ES futures, I got nothing, nothing under 39.31. There is no, in my opinion, there is no good or happy place under 39.31 in this marketplace. Okay, I am going to pull back to like a 3-year. I do have other gravity points from years ago. Okay, the next one is not down to 3,200. I'm in no way, again, implying that I just left them on the chart. What I want you to see, though, is, again, breaching for new lows, I don't think means anything. I mean, seriously, new lows, yeah, whatever, 3,600 and away we go. But there's no good place under 3,900. This just implies just outright wild volatility. We very well could be in some rough shape next week. Look at the bounces, all right, coming to this marketplace is opportunistic. We're gonna have some rip your face off rallies. There's no question about it. Okay, but at this point in time, anything under that 39.31 is really dire for the marketplace. And as we start to descend, okay, even the slightest bit lower, this is where I would expect some of that volatility to start to pick up, because I'm fairly certain that trade and traders are looking at it the exact same way as I am. Hold the line, we lose it. There's no good place under 39.31. All right, last but definitely not least, the SPX, the mother of all products. Now, the market just closed. We don't even have an expected move, at least definitive expected move yet for next week. Mind you, next week is what? It's a 4-day trading week. Monday, markets are closed. Equity and bond markets are closed, of course, for the Labor Day holiday. Okay, we are and have closed outside the expected move this week. And it's considerable enough that, of course, we're going to mark it on the screen. Therefore, we have now two consecutive weeks, all right, of a marketplace that is outside the lower edge of the expected move. And by the way, speaking of 2 consecutive weeks, there are a tremendous number of recent breaches. There's 1, 2, 3, 4, 5 breaches. 5 breaches in how many weeks? Okay. Again, markets are becoming unruly. Here's week 1, 2, 3, 4, 5, 6. This is the 7th week. 5 out of 7 weeks, we're actually breaching expected move. That's unto itself, okay, is, again, it's showing you markets are displaying degrees of inefficiency, right? And we actually saw these inefficiencies earlier in the year. We mellowed out a little bit. But again, when I say inefficiencies, we're getting downright wild here. With that, we're expecting a $108 move, tried for the corner and missed. We're outside it. If you take a look right now at the SPX, next week, again, a 4-day trading week, we're shooting for somewhere around a $94 expected move. Now, again, we're compensating for the fact that we have a 4-day trading week. That is not dissimilar. We just came off of a week with about a $108 move. We're going to be coming into a week with a $94 move. Okay, listen, things are just going to be downright volatile from here on out. In terms of positions, okay, we've added them, we've subtracted them, we've got tremendous number of positions on and working at present time. Stay tuned and tune into any of the TheoTrade videos, the updates from the in-out spread update, the update, of course, from the TheoTheta portfolio, the TheoTheta small portfolio, to see all the moves I made throughout the course of this past week. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful holiday weekend. Bye-bye.